Hey guys, today we're talking about value investing, what you need to know, what to avoid, and how to make sure you do it the right way. I'm Rob Tatro from robtatro.com, portfolio manager here, Canaccord Genuity Wealth Management, and at the Tatro Wealth Advisory Group. Brings me great joy to be here. I love talking about anything market related, so let's get right into it. Before we do that, take a sec, subscribe. Press the red button, subscribe to our YouTube channels, like our Facebook page, share it with all your friends and family. We put out good content. We'd love to hear your comments. If you got comments on value investing, we'd love to hear them. So let's get into it. Value investing. So most popularized definitely by a gentleman, Warren Buffett. You may have heard of him. He's the best known value investor today. So there are a whole bunch of other ones, Benjamin Graham, Charlie Munger, Seth Klarman. These are all individuals that have gone out of their way and said that we want to buy stocks when they represent value. So when they're trading less than their intrinsic or book value. The key tenet for value investing is an investment strategy that involves picking stocks that appear to be trading for less than their value. How do you define their value? Some people will do it through a book value. Some people will do it through an intrinsic value. But basically, value investors, they think that for some reason, the stock market is underestimating the value of a specific company. Usually, they'll use financial analysis. Usually, they don't follow the herd. And usually, they are long-term investors of quality companies. There are cycles throughout the last 100 years or so where value companies have outperformed. And there are cycles where growth companies have outperformed. Today, we're talking about value investing. So the concept is pretty straightforward, right? You see a TV, you think, oh, I want to buy this TV. I think it's worth $1,000. Oh, it's on sale for $700. I'm going to buy it now. But if it's worth $1,000 and you know that it never goes on sale, you'd pay $1,000. Well, we all know how TVs work in electronics. They go on sale from time to time. There might be a Boxing Day sale. There might be a June summer spectacular sale. And when those happen, you know they're going to happen. You're just going to buy them. You're going to wait and you're going to buy them when they're on sale. Same concept applies to stocks. The theory is that on a day-to-day, week-to-week, month-to-month basis, stocks are eventually going to trade at a discount to their value for a whole bunch of reasons. But some of that is fear or greed, and some of that is just what's happening in the world. Some of that is expectations for future drop in earnings. Whatever it may be, there are reasons that stocks trade at a discount to value. Value investors will tell you, I'm going to wait and I'm going to pick it up at the price. Now, what price should you wait for it to drop at? Let's say you value a company at $100. There's a concept called the safety margin or the margin of safety, where some bright minds have once said, don't buy it unless you're at 30% margin of safety. So it's got to be 70 cents on the dollar is what you want to pay, or it's got to be 80 cents on the dollar. Whatever it is, that becomes your margin of safety. So value investors will not buy those stocks unless they dip below that margin of safety, because in their mind, once they buy it on a margin of safety, not only in their mind are they sure to make the value back once the value is fully recognized in the company, but there might also be growth, right? If there's growth in the company, by then the value of the company will go up. There's a whole bunch of metrics here that we want to look at. So let's take a look at a few. Price to book. Okay, so price to book is the value in which measures the value of the company's assets and shares to the stock price. So the book value to the stock price. So if the price is lower than the value of the assets, then the stock is undervalued. And if the opposite is true, then the stock is overvalued. Now, price to book in some sectors is not necessarily a great measure because the assets are tougher to identify, or they're tougher to measure, or an asset might be more intangible. So another way to look at it is price to earnings, P to E, price to earnings ratio. This is probably the ratio that gets talked about the absolute most in the investment world. You have $1 of earnings for a company. How much is that company trading for in the open market? Is it trading at 10 times earnings? 15 times earnings, 20, 25, 30, 50, 100. There are companies that can tell you in the extreme growth space, they don't trade on a multiple of price to earnings. They trade on a multiple of price to sales or price to revenue. So in other words, these companies are nowhere near profitable. A value investor would never buy those companies. A value investor would never buy companies that are not profitable unless there's a specific reason. But generally, they stay away from those companies that have huge hockey stick growth and they're expected to double or triple their revenue over the next 3 or 5 or 10 years. Value investors don't want to touch those, okay? Value investors will also look at free cash flow. They're going to look at a multiple of the cash flow today that we can get. So if I know I can get $1 of cash flow, if I knew that I could get $1 of cash flow in my TFSA every single year, what would I pay for that? What would I pay for $1 of cash flow? Well, is it $8? Is it $10? Is it $12? Whatever it is, that's something to consider. And then you have to ask yourself, is that cash flow going to grow? Am I going to get a little bit more cash flow next year? If I'm getting $1 this year, can I get $1.10 next year? And if yes, what value do we put on that company? So price to book, price to earnings, and free cash flow, 3 often used metrics to evaluate whether or not there's value in a company. Now, we all know that markets are thought to be extremely efficient, but value investors don't believe in the efficient market theory. The efficient market theory says that all the information on the planet is priced in, and everyone knows all the information that is available. Therefore, if you're making a stock pick, if you're doing some sort of prediction, it's already priced in. It's very difficult for stocks to be over or underpriced based on those reasons. So value investors are convinced that that is not the case. They think their psychological biases can push a stock up or down based on news or disappointing or effectively noise, right? Product recalls, litigation, maybe stocks are trading under the radar. I like to consider this noise, right? So a lot of times you'll see a stock, there'll be noise will come out. Someone will tweet something about a company. A former president may say, that stock's terrible, or perhaps there might be a global ban on a company, or perhaps there's a talk of maybe something happening. And then we see the stock drop 10%. Well, a value investor would say, keep calm and buy on the dip, right? That's what a value investor might say. And they're going to try to do that. They're going to see that dip. They're going to say, this is just noise. I'm not terribly worried about this. I'm going to keep calm. I'm going to buy on this dip. Ideally, I can get it at 70 cents on the dollar. I know what this company is worth. I know that the earnings are there. I know the cash flow is there. $1 of cash flow is worth X. Therefore, I'm buying that company. So value investors, they're also not going to follow the herd. They're going to say, I'm contrarian. I don't believe that, everyone's putting their money in penny stocks and mining stocks and growth stocks, and everyone's doubling and tripling their money. They don't want any part of that. They're contrarian. Or when all of a sudden everyone wants to be in value stocks, they're not going to be buying because the values have appreciated, right? So that's part of what they do as well. So at the end of the day, if you're a value investor, what you care about is your dollar revenue, your assets, your price to book ratio, and you want to make sure that you're buying at a discount to that. And if you play that well consistently over the long term, guys like Warren Buffett will tell you that you're going to be laughing, because not only are you going to get appreciation of your stock back to a reversion to the mean, but you're also going to get growth on that earnings, if you will, or that dollar of earnings is going to grow to $1.10, and you're going to eventually get that multiple. It's a more sure way of playing the market, less volatility than growth stocks. And if Warren Buffett were here, he'd say the only way that he wants to play it. And you know what? He's been right for a very long time, but he's definitely been wrong in some cycles as well. So value investor, you want to find that diamond in the rough, typically large cap companies trading at a significant discount. You're going to buy it, you're going to add it to your portfolio, you're going to sit on it, and you're going to wait for the full value to be reflected before you sell that position. Value investing, not to be confused with growth investing. It's been in favor for a long time. It's out of favor right now. Growth investor is now the one that's in favor. If you're not sure how this impacts you, how this impacts your portfolio, by all means, go to www.speaktorob.com. We'd love to book a no obligation consultation with you to chat about whether or not you have enough value stocks, or you have growth stocks, or you should have more of one or the other. We'd love to do that with you. Thanks for tuning in, guys. I'm Rob Tatro from robtatro.com, portfolio manager, Canaccord Genuity Wealth Management, and the Tatro Wealth Advisory Group. I'd love for you to subscribe, press the button, subscribe, and give us a like, a share, a follow. Appreciate you taking the time today. We'll see you in the next video.